Global Advisors co-founder and CNBC contributor Tom Lee. Tom, it's great to have you. Thanks for helping us start the hour.
Yeah, great to see you, Carl.
You've done some work in the last couple of weeks, I know, at least looking at various components of CPI that, in your words, are falling like a rock. It does sound, though, like that disinflationary thesis is kind of tough sledding when it comes to talking to your clients.
That's right. I think the bar is pretty high for investors and markets and the Fed to be convinced inflation's breaking. I mean, part of it is because inflation is so uncertain that, the market wants to have comfort that it's truly vanquished before they think the Fed could even consider being a little easier. But I think one of the things that is giving us a lot of encouragement is, when we look at the 70s to 80s, gasoline never had a drawdown, a decline of more than 2% on a year-over-year basis in CPI until 1982. We're already starting to see gasoline, as you mentioned, fall like a rock. Housing, which has been the one thing that people consider quite sticky and saying shelter could be inflated through the end of next year, is already starting to roll over when you look at the high-frequency data like from Redfin or Zillow. And, 42% of the CPI basket of price indices are already deflating from their peak. I mean, that's a pretty huge number. So I think that investors should be encouraged that the price sort of impulse of rising prices, I mean, that's hit some sort of wall. We think it's actually going to fall pretty quickly.
Yeah, that's interesting. Although the Fed's messaging, Tom, has been essentially goods deflation doesn't impress us much. We want to see it reflected in wages. And I just wonder whether or not you thought Friday's print on jobs, directionally, the sense was that it was a move in the right direction, but then it got steamrolled by the Nord Stream headlines.
Yes, that's right. There are other things while the worry out there that investors are, look over their shoulder. They see China and they see the Russia-Ukraine war and they see the energy crisis in Europe. So these are giving investors pause. But, as a lot of economists note, a lot of those impulses from Europe rarely come back into the U.S. either as inflation. In fact, they tend to just come back as weakness if there's a downturn, and that actually is disinflationary. But I think one of the things we should be heartened by is even if you look at the employment data, there is a pretty big gap between what's called the household survey and the establishment. In the last 5 months, there hasn't been any growth in full-time employment in the household survey. So I think the job market is indeed a lot weaker than it appears.
Hey, Tom, it's John. Good morning. What kind of data do we have to get heading into the holiday season when it comes to retail and the health of the consumer to keep the market from going down from here? I'm curious what sort of signals necessary for you to stay optimistic.
Well, it's in a way, it's a half full, half empty setup because we know sentiment is pretty negative and we know positioning now is similar to where it was, actually pretty close to March 2020 lows or even the GFC. But there has to be a fundamental backdrop that supports investors willing to put money to work. And I think, to me, maybe the biggest thing in the next 3 months is going to be the CPI reports. I just think we're underweighting how important the drop in gasoline's been. Gasoline has fallen huge. That actually does flow eventually into core services through, both bills and then the cost of travel and the cost of moving food. So the drop in gasoline, I think, is really going to show up as deflation later in services.
So, Tom, even though you're positive, you don't sound that positive, right, on the markets. Have you gotten incrementally less positive over the last few weeks or no?
Well, I would say it just feels like we're still teetering on this cliff, and investors are really nervous. So I think, I think the bulls do have to sort of prove their case. But, we've been trying to be led by what we consider to be leading indicators of inflation because we think that still grounds much of what will drive markets. The one thing that gives us comfort is the bond market is a lot more convinced about the Fed vanquishing inflation than the equity market. Because if you look at inflation swaps, for instance, for the next 6 months, first of all, the next 2 months, if you look at inflation swaps, we're talking deflation. The inflation swaps market is saying we're going to have falling prices next 2 months. And for the next 6 months, inflation annualizing under 2%. So I think stock market just needs to be convinced of what the bond market is seeing.
Tom, good morning. It's Deirdre. We've been talking to a number of enterprise CEOs on the show over the last week, and the takeaway has been, even from ones that have posted strong earnings like PagerDuty and Samsara, is that they're all seeing lengthening sales cycles. Do you think that the market has priced this in, especially the effect that this could have on the major cloud players, or could this be another shoe to drop?
It's one or the other. It's clear that business leaders and CEOs have become more cautious, and that's why we're seeing the PMIs weaken and the sales cycle and even like hiring plans slow down. But at the epicenter of all that is an abrupt change in monetary policy. I think that when we look back, this is our expectation, this is going to look like the 1980 recession, where it was almost announced on cue because monetary policy wanted to try to abruptly slow the economy. That's a pretty unusual policy shift by the Fed. It's normally in other business cycles, we have an overheated economy, incremental returns of invested capital are turning negative, so the Fed is trying to intervene. This is almost a, let's just step on the brakes just to kind of slow things down. So I would say a lot of these cautionary moves by companies aren't necessarily because there isn't a demand, it's because demand slowed because of caution. It's a little circular, but I just think a lot of this can reverse if inflation starts to weaken.
Okay, Tom, and while we have you, I do want to get your view on crypto. As the 120-day correlation between Bitcoin and the stock market, that's at all-time highs. What does that mean for Bitcoin's trajectory ahead of the Ether merge and as Bitcoin remains under 20K?
Yeah, it's a great question. I mean, I think Bitcoin and crypto is still sort of reeling from those shocks that occurred earlier this year that had to do with Three Arrows Capital and other events. And so, there is a equilibrium being established. I don't think that the thesis for owning digital assets has been destroyed. Digital assets really do serve a pretty important purpose and really cut and reduce the cost and improve the access to banking for a lot of people outside the U.S. But this is going to take time. And I think the ETH merge is a pretty big event that's being closely watched. But I think I would say overall, I've been pretty impressed that crypto has actually hung in there because, when people talk about economic, like pessimism and the Fed being tight and risk assets being, something people don't want to touch, Bitcoin's kind of held in there. So, I think I'm pretty encouraged.
Yeah, it has been sticky around 20K. Tom, pretty fascinating given the chop we've seen in other asset classes. Great start to the hour with you. Thank you so much, Tom Lee, Fundstrat.
Thank you.